Let's get to some other stories and movers. And one name that's a big laggard on the S&P 500 is Onsemi. Diane King Hall, host of Morning Movers, is with us, and she's taking a look at a few of the names. Now, Onsemi, good quarter, but under pressure.
Yes, and I think that we're seeing the pressure now because we're essentially in the middle of the earnings call right now. And the stock was actually initially indicating higher in the pre-market because, look, they did beat expectations. There was indeed bleeding on the balance sheet for Onsemi. It lost more than $486 million. If you strip out those one-time items, adjusted EPS was 55 cents a share. The street was looking for 51 cents a share. Revenue came in at $1.45 billion, which was a beat. Street was looking for $1.41 billion. But to put it in perspective, it is down more than 20% on a year-over-year basis. Where did you see the strength in terms of revenue? Power Solutions Group, PSG Group, PSG, that's what they call that. It was more than $645 million. In terms of share price action, we are seeing it get hit pretty hard, and the losses accelerate down more than 7% today. It has been under major pressure year to date. Now, it's well off the highs that we saw back in 2023 year to date. It is down more than 30% this year, and on a year-over-year basis, even more, probably approaching the 40% level. Now, look, they had guided for the issues that they would have from the previous quarter. They had, they said the results in this latest quarter reflect the disciplined approach they've maintained through the downturn, managing cost structure, right-sizing, manufacturing footprint. But I imagine they're probably being pretty frank on the earnings call as they were in the previous earnings call. The headline on guidance for the second quarter is they're guiding for a range of adjusted EPS to come in between 48 to 50 cents a share. She was looking for just 51 cents. Revenue, they're guiding for 1.4 to 1.5 billion. Versus 1.41 billion. But again, they have the exposure, especially to the autos, because they supply so many chips to autos. And when you think of, obviously, EV and EV demand, it does require more chips. But they had said on their previous earnings call, and I wonder if there was some more commentary reflecting that the automakers still really had too many chips. We'll see if there was any kind of pull forward demand. I'll be listening to the transcript or reading the transcript of the call later. But I imagine that's what's happening right now.
And what's interesting, too, is that this stock is down almost 8% right now, right? And it did have a beat. All the other names in the semi group, I won't say all, but I looked at SMH, I looked at stocks, I looked at NVIDIA while you were talking, Qualcomm, which is sort of related, none of which are moving more than 0.5%. They're all down 0.5%. So nothing's moving in sympathy with this name and saying, oh, we have a big picture problem on semis. That doesn't seem to be the case. I mean, this is definitely having direct reaction because those ETFs that cover these semis are not doing much right now. Tyson Foods also on your radar?
Yep, Tyson Foods. It reported a mixed quarter off of its latest results. It did beat on the bottom line, but it missed on sales. So there was some weakness in some segments. Adjusted EPS came in at 92 cents a share. Street was looking for 85 cents. Revenue came in at just above 13 billion, but the street was looking for higher than that. They were looking for 13.1 billion. It was the weaker than expected sales was led by a decline in sales of beef and pork, particularly beef. Now, chicken sales did help soften the blow. You saw growth in chicken sales, but then in terms of their guidance for 2025, they're guiding for sales to be flat to up 1% in fiscal 2025. They also mentioned some legal matters that they have to account for with regard to their guidance, and that hit their numbers as well in the trailing quarter. They gave some perspective on what the indication is for demand this year for meat, essentially. For 2025, they're projecting overall 1% increase in demand for meat, whether we're talking about chicken, beef, or pork. That's in total. But beef production is expected to be flat this year. So they're anticipating a loss in that segment. Pork production is expected to increase just slightly for that, and chicken production is expected to increase 2% in this year. So it sounds like, again, that the trend we're seeing in this quarter, they expect to play out through the balance of this year, that chicken sales will have some strength, but beef and pork, not so much.
And look, I mean, beef, certainly the more expensive item. of the group, right?
Yeah,
so someone who's
100%.
saying I might want to get some protein for my family may not choose, a nice big porterhouse or something. That being said, I mean, these consumer type stocks are not doing particularly well right now, right?
You're absolutely right, Nicole. And in terms of how the street views Tyson, they're largely in the hold camp when it comes to Tyson. So it's not really anything that is, kind of moving the needle. I haven't seen any investor activity, any sell sides who are updating their views to, becoming more constructive on Tyson. So it's certainly expected to, kind of pretty much stall out this year. The stock is down 6% right now, Nicole.
All right, and last but not least, we have XYZ. That was they had a lot of high hopes for this name and didn't really execute.
They didn't, especially on their latest quarter. So this is another analyst who is downgrading their view on Block. They're downgrading to a neutral. This is Macquarie downgrading to a neutral from outperform. Significantly slashed their price target. They've slashed it to $50 a share. That's down from 110. That's a sharp cut. It just reflects growing concern about the outlook for the company. They see scope for just more softness when it comes to the consumer and that weighing on the company. We already knew that Cash App had some fragility, and they cited that in the recent quarter about the macro picture for Block. I always have to catch myself because, it used to be a Square. And there are multiple analysts who had flagged this recently, especially when you think about it as a key performance indicator for the company, Cash App, and the gross payment volume. It's still seen as a banking alternative, but again, the growth story is not there right now in a challenging macro environment. So you have them as the latest. I mean, you keep in mind you had other analysts who downgraded their views recently. You had BMO Capital, Seaport Global, Benchmark. They all had similar views shifting to neutral on XYZ. And so the stock continuing its downbeat pattern, recently down about 2% today.
Yeah, and folks, I mean, this name is really at 52-week lows. Folks, as we were saying, the Cash App, there was a lot of excitement. I saw a buy rating from Goldman Sachs in April. People were on board for Block and then really sort of got hit hard. I mean, month to date, it moved 20%. So it's down now for this month of May, 21% already. At what point are people going to start to say, hey, well, this is an attractive valuation. Maybe they'll start to jump in. I don't know. But for right now, not buying it.
Absolutely.
All right. Diane King Hall, great to see you on a Monday. We're kicking
you.
off a busy week of lots of earnings and news.